Hi everyone, good morning to all. Today we are going to start our next part of our topic financial market, that is structure of financial market. So before going to discuss the structure of financial market, again I am reminding to you the meaning of financial market. So financial market can be referred to as those center and arrangements which facilitates buying and selling of financial assets, claims and services, or market where entities can trade financial securities, commodities at low transaction cost and at prices which reflect the supply and demand. So that means financial market is a place where financial transaction take place. That financial transaction in terms of financial securities, which includes stocks, debentures or bond, or commodities that includes precious metal or agricultural goods, that is traded in financial market at very low transaction cost, and the prices are determined based upon the supply and demand. So now I am giving a brief structure of the financial market. The diagram you can see it. The classification of financial market, broadly it is divided into two parts, that is organized market and unorganized market. So under unorganized market there is money lender, indigenous banker, etc. And under organized market there is mainly two types, one is your capital market, second one is your money market. So the capital market is subdivided into three parts, that is your industrial securities market, government securities market and long term loan market. The industrial securities market is divided into two parts, that is primary market and secondary market, and the long term loan market that is divided into three parts, that is your term loan market, mortgage market, guarantee market. So under organized market there is another one which is called as money market. Money market is subdivided into five parts, that is your call money market, commercial bill market, treasury bill market, short term loan market and foreign exchange market. So this is the brief structure of the financial market. One by one we have to discuss it. So first we have to discuss unorganized market. What is that? The financial transaction which take place outside a well established exchange constitute an unorganized market. In this market there are number of money lender, indigenous bankers and traders, etc. who lend money to the public. There are also private finance companies or cheat funds, etc. whose activities are not controlled by RBI. The regulations concerning their financial dealings are still inadequate and their financial instruments have not been standardized. So in simply we can say that unorganized, as the name suggests, that means there is no standardized rules and regulations, or there is no regulatory bodies. The organizations, those are providing the finance facilities, they implement their rules and regulations and accordingly they will conduct their activities. So there are some examples of unorganized market. One is your money lender or cheat fund or any finance companies, etc. or any traders. Those implement their rules and regulation and provides finance, those are having need of money, and based upon their rules and regulation everything will be conducted. There is no standardized rules and regulation, there is no regulatory bodies under whose guidance this market is conducted. So there may be certain chances of risks and the risks may be to some extent high. Then next come to organized market. Organized market is that part which comes under the regulatory purview of RBI and SEBI. There are standardized rules and regulations governing their financial dealings. There is also a high degree of institutionalization and instrumentalization. This organized market can be further classified into two, that is capital market and second one is your money market. Under organized market there is standardized rules and regulation. There is regulatory bodies, that means Reserve Bank of India or RBI and a Securities Exchange Board of India, SEBI. These are the most prominent regulatory bodies. Under their rules and regulation, under their guidance the market is regulated. That is why it is called as organized market. So there is standardized rules and regulation, there is proper guidance provided by the regulatory bodies or by the financial markets, and everything is conducted smoothly and there is no chances of risks. So this organized market is divided into two parts, that is called as your capital market and money market. One by one we have to discuss that. So first we are going to discuss regarding capital market. What is capital market and what are the subdivision of capital market? It is a market for financial assets which have a long or indefinite maturity. Generally, it deals with long-term securities which have a maturity period of above 1 year. It may be further divided into three parts, that is industrial securities market, government securities market and long-term loan market. So, under capital market, the shares or securities is traded generally a long-term period. Generally, the time period is more than 1 year. So, that is why it is called as there is indefinite maturity, maybe 1 year or more than that. So, it have a long and indefinite maturity and the maturity period is generally over 1 year. And the subdivision of capital market is industrial securities, government securities and a long-term loan market. So, next we have to discuss industrial securities market. So, what is that? As the name implies, it is a market for industrial securities, namely equity share, preference share or debentures or bonds. It is a market where industrial concern can raise their capital or debt by using appropriate instrument. So, under industrial securities market, generally shares, maybe equity share or preference share or debenture or bond that can be traded. Generally, all type of industrial concern, when they want to raise their capital or there is need of money, they want to raise by issuing shares or debentures or bond. So, that is why it is called as industrial securities market. Only industrial concern can raise their capital by issuing any type of a share, or they can raise their money by issuing debentures and bonds. So, that industrial securities market is subdivided into two parts, that is called as primary market and a secondary market. The primary market, it is otherwise known as new issue market. The secondary market, that is called as your stock exchange. So, what is primary market? A primary market is one where securities are sold to the investor for the very first time. So, in primary market, entities can raise their capital by issuing securities for the first time to the public, and that may be issued in the form of a initial public offer, that is called as IPO, or that may be FPO, that is follow public offer. So, in primary market, securities are sold to the investor for the very first time. That one example is initial public offering, and in primary market, borrowers exchange new financial securities for long term funds. So, as for the first time it is issued, so generally borrowers can exchange their new financial securities, and that is for long term period, as it is coming under your capital market. So, there are three ways in which a company can raise capital in primary market. So, in primary market, company can raise their capital by way of three kinds, that is called as public issue, second one is right issue and the third one is your private placement. So, what is public issue? When an issue or offer of securities is made to the new investor for becoming a part of shareholders family of the issuer, it is called as a public issue. Issue of securities made to the new investor for the first time, that is called as a public issue, and issue is made to only to the public. Public issue can be further classified into two parts, that is initial public offer IPO and a follow-on public offer FPO. Second one is right issue. A right issue is an invitation to existing shareholder to purchase additional new shares in the company. So, here or in case right issue, company provides assurance by giving preference first to the existing shareholder. The existing shareholder have the right to purchase the shares from the company, that is called as right issue. They have the rights because they are called as the existing shareholder, and the company will issue the shares to the existing shareholder or giving priority by issuing shares at a discount. So, this type of a issue gives existing shareholder securities called rights, and with the right the shareholder can purchase new shares at a discount to the market on a stated future date. So, as they are the existing shareholder, they are having that rights, they can purchase the shares from the market newly and at a discount price, and that provides to the market price on a stated future date. The third one is private placement. It is a way of selling securities to the privately to a small group of investors. So, here company gives rights only to the small investor. So, that is called as private placement. The way of selling securities privately to the small investors or small group of investor is called as a private placement. So the next one is your secondary market, which is called as a stock exchange. After the shares are listed in the primary market for the first time, then the shares are issued or listed on the stock exchange, that is called as a secondary market. The secondary market is a market where investors buy and sell securities they already own. What the investors newly own in the primary market, again that shares they can trade it in the secondary market. They can buy it or they can sell it. It is what most people typically think of as the stock market. So it is otherwise called as a stock market. Though stocks are sold on the primary market when they are first issued. So in primary market, those shares are listed for the first time, again that is coming into the secondary market. Every investors, those are having that facility, they can buy the shares from the secondary market or they can sell the share from the secondary market. So this market consists of all stock exchanges recognized by the government of India. So this is called as your secondary market, which is coming under your organized market. So there is proper standardized rules and regulation. So there is stock exchange which provides that facility to trade or to buy and sell the shares in the secondary market. So that stock exchange is regulated by the government of India or recognized by the government of India. The stock exchange in India purely regulated by Securities Contract Regulation Act 1956. SCRA Act, here it is mentioned, that means it is called as Securities Contract Regulation Act. One act is passed by the government of India in the year 1956, and under that act there are various types of rules and regulation or criteria or formalities under whose guidance or formalities the investors can trade or to buy or sell the shares. So the stock exchange purely regulated by Securities Contract Regulation Act, and that act was established in the year 1956. And in India there are two prominent stock exchanges. One is called as your Bombay Stock Exchange, which is known as BSE, and another one is called as National Stock Exchange, which is known as NSE. Then the second one is your government securities market. Government securities are securities issued by the government for raising a public loan. So here government, it is purely issued by the government for raising public loan. It is otherwise called as gilt-edged securities. Government securities is otherwise known as gilt-edged securities. Securities is issued by the central government or state government or semi-government authorities or public sector enterprise are dealt in this market. So as it is government securities, so government means that may be central government, that may be state government, that may be semi-government authorities or any public sector enterprises. They are coming under this category. Most government securities issued by the Reserve Bank of India on behalf of Indian government are interest bearing dated instrument. So as it is government, so purely regulated by Reserve Bank of India or RBI, and on behalf of Indian government or central government, and that is dated instrument or interest bearing dated instrument. Certain kind of rate of interest that must be mentioned while issuing that instrument. The third one is your long term loan market. So basically most development banks and commercial banks, they play a significant role in this market by supplying long term loan to corporate customer. So most probably most financial institutions or development banks as well as different commercial banks, they play a very significant role in this long term loan market, and they provide loan basically for long term period and generally giving priority only to the corporate customers. It may be further classified into different parts, that is term loan market, mortgage market, market for financial guarantee. So what is term loan market? Many industrial financing institutions have been created by the government both at national and regional level to supply long term and medium term loan to corporate customer directly or indirectly. So term loan market, that means it is coming under industrial concern or industrial financing institution. They have been, those are created by the government, that may be created at the national level or at the regional level, and they supply long term loan or medium term loan only to the corporate customer, and that may be directly or indirectly. The industrial financing institutions generally IDBI, IFCI, ICICI or any type of other financial corporation, they are coming under this category. They are having that priority to provide loan to the corporate customer generally for a long term period. Next one is mortgage market. It refers to those centers which supply mortgage loan to individual customer. So here loan is provided to the customer by taking mortgage from them. A mortgage loan is a loan against a security of immovable property. So here basically it is taken as security, and security is in the form of a immovable property. The primary mortgage market is the market where borrowers can obtain a mortgage loan from a primary lender. So generally individual, when they want loan, they are deposit their security immovable in the form of a security immovable property and taking the loan from the bank or any financial institution. So generally banks, credit unions are all primary lender and are part of the primary mortgage market. So generally the mortgage market is two parts, that primary market where bank and lenders is there, they provide loan, and another one is secondary mortgage market. The secondary mortgage market allow banks to repackage and sell mortgage as securities. Again that repacked by the bank or by the financial institution and sell as securities to the institutional investors. These investors include large pension fund, insurance company. So when taking the loan, taking the securities in the form of a mortgage in primary mortgage market, again that is repacked and sell to the investors in the form of a securities and basically to the institutional investors, and those institutional investors are called as pension fund or insurance company. The next one is your financial guarantee market. A guarantee market is a center where finance is provided against the guarantee of a reputed person in the financial circle. So here loan is provided and that is in the form of a guarantee. One guarantor is there who is in charge of that providing the loan. He acts as the middleman, and basically that guarantor is from a reputed person from the financial circle. Guarantee is a contract. So here contract is made to discharge the liability of a third party in case of default. So the guarantor will be liable if the person who takes the loan fails to repay the loan to the institution, then ultimately that becomes the responsibility of the guarantor, or the responsibility falls on the shoulder of the guarantor. He become liable or she become liable to repay all the amount of interest as well as the principal to the institution. Those are providing the loan to the person, those are having need of money. In case borrower fails to repay the loan, the liability falls on the shoulder of the guarantor. So when the borrower fails to repay, is unable to pay the amount with interest, then every type of responsibility or a risk is falls on the shoulder of the guarantor. He or she becomes liable to repay all the amount of loan as well as the principal and interest. So this is all about capital market. The next part is under organized, which is called as money market. As per Reserve Bank of India, a market for short-term financial assets that are close substitute for money facilitates the exchange of money in primary and secondary market. So money market is market for short-term period, generally within 1 year or less than 1 year. So here it is very liquid. So it is a market purely for short-term funds. It includes all individuals, institutions, intermediaries dealing with short-term funds. So we are providing facility to all. Individuals enter into the money market, institutional investors also enter into that, intermediaries also there, but basically that is for a short-term period. That's why it is called as money market and it is very highly liquid. So next, what is the composition of money market? Money market consists of a number of sub-markets which collectively constitute the money market. So under that, the first one is call money market. It is a market for extremely short period loan, generally 1 to 14 days. So as money market is for short period, generally within 1 year. So call money market, the time period is between 1 to 14 days. That's why it is highly liquid. The loans are repayable on demand either at the option of the lender or at the borrower. From any side, the loan is repayable. It is very sensitive to change in demand and supply of call loans. So it is very sensitive as it is very liquid or highly liquid, that's why it is called as sensitive, and that sensitive changes in demand and supply of call loans. The second one is commercial bill market. It deals in bill of exchange. A seller draws a bill of exchange on the buyer to make payment within a certain period of time. The bill can be domestic bill or foreign bill of exchange. So, in commercial bill market, generally it is traded in bill of exchange. So, in bill of exchange, where the organization sells goods credit to the customer, that organization raise a bill against the customer, promising the customer to pay within a certain period, and that is taken into consideration without waiting for that period. Instantly the organization, those are providing the goods on credit, they deposit that bill in bank and discounting it at certain price and take the money from the bank. Again the bank is responsible to collect the money from the person to whom the goods are sold on credit. So, that is bill of exchange, and that is coming under commercial bill market. So, that bill market or commercial bill may be domestic bill or foreign bill. The commercial bills are purchased and discounted by commercial banks and are rediscounted by financial institutions like Exim Bank, Export Import Bank, SIDB, Small Industries Development Bank of India, IDBI, Industrial Development Bank of India. So, all type of commercial banks, they are taking the facility to discounting that bill, or again that rediscounted by different types of financial institutions. Then next coming in treasury bill market, it deals in treasury bill of a short term duration. So, generally money market means short term, it is generally treasury bill also coming under short term duration, and the duration period may be 14 days, 182 days or 91 days or 364 days, like that. So, they are issued by the government and largely held by RBI. So, generally treasury bill issued by only government and in favor of a Reserve Bank of India. The treasury bill facilitates the financing of central government temporary deficiency. So, when there is need of money by the government, then treasury bill issued during that period. So, when central government is deficit or there is need of funds, in that case the treasury bill issued. The rate of interest for treasury bill is determined by the market depending upon the demand and supply of funds. So, here interest rate is determined based upon the demand and supply on the market. So, there are two types of a treasury bill, one is ordinary or regular treasury bill, second one is ad hoc treasury bill. Ordinary treasury bill are issued to the publics, banks or other financial institutions with a view to raising resources for the central government to meet short term financial needs. So, when central government is in need of short term funds or short term needs, in that case ordinary treasury bill or regular treasury bill is issued, and ad hoc treasury bills are issued only in favor of a Reserve Bank of India. The next one is short term loan market. It is a market where short term loans are given to corporate customer. So, here corporate customer, they are having that priority to take money or loan from the money market for a short period, only to meet their day to day working needs, day to day money, or which is called as working capital. Commercial bank plays a significant role in this market. So, commercial bank plays an important role by providing money to the corporate customer for short term needs to meet their working capital requirements, and that is in the form of a cash credit or overdraft. That loan is provided either in the form of a cash credit or overdraft facility. The last one is foreign exchange market. It refers to the process of converting home currency into foreign currency and vice versa. So, foreign exchange, that means converting the home currency into foreign currency or converting the foreign currency into home currency. That is the role player in foreign exchange market. It is a market where foreign monies are bought and sold. So, here foreign monies are transacted. Foreign exchange market is the market for a national currency anywhere in the world, as the financial center in the world are united in a center or in a single market. So, in the world all type of financial center, they are coming under one, that is a single market. So, foreign exchange market is, that is market for national currency. Thank you all.